Welcome to the channel. This is Jack Graham. Today I'm talking about whether or not real estate prices are going to crash in this environment with interest rates rising very fast, and what's going to happen to homeowners, home buyers, people that are in the market right now. What are the consequences to this big move in interest rates? We're going to go over it right now together. So in order to do that, I'm going to minimize this thing right here, and let's see. So right here we have an article and that I really liked. I thought it was an amazing article, really breaking down the difference between the Great Recession that we had back in 2006 and today's market, what's happening in today's market with rising interest rates. So I wanted to go over this one, give you kind of like an overview of what they talked about, and also not only compare it, but also give you the market data that we have today in today's market, and see if this actually makes sense on what they're talking, so that you can make a better educated decision on whether or not is the right time for you to buy. Anyway, as you can see right now, we have mortgage rates rising to 5%. For the first time, they're above 5% in a very long time. I think it's like in 10 years or so. But yeah, so that's the situation right now. But what's happening in the market? I don't know. It's tough to understand what's going to happen in the short term. However, I have not seen a big difference. But in order to understand what's going to happen today, we have to go back in history. We got to go over what happened back in 2006, what happened in prior recessions, what is the usual reaction, in the market based on what happens with interest rates. So with that said, let's get into this article right now. As you can see, median home listing price is up at $405,000. This is nationally speaking. And that is as of March of 2022. March of 2022 technically is keeping in consideration the homes that sold in January and February, or at least got under contract in January and February, when you're talking about the resale market, right? So you would have interest rates locked back in January or February. So the data that we're getting from here, 405,000, is according to homes that got under contract in January and February. So keep that in mind. But there's an increase of 26.5% over the last 2 years. Crazy home appreciation that we've had in the last, since the pandemic hit. Now, home buyers might see similarities between this 2006 housing market crash that we had, like the housing bubble that we had over a decade ago, and today's situation where home prices are not really as affordable as they used to be. And there are a lot of stressed out buyers. It talks about here, and 77% of buyers. This was a very interesting statistic here. 77% of home buyers believe that there's a bubble where they live. And I think most of the reason why this is the case is because everybody has a fresh wound from the last crisis, which was pretty much the Great Recession, right? They used to call it. And everybody thinks that just because prices crashed back in 2006, 2008, that's what's going to happen today. But that's not necessarily the case, and that's what we're going to try to discover today using some data and some different opinions from different people. So, in today's market, it's really significantly different from 15 years ago, right? When home prices were that high back in the day, we had price increases due to the fact that we had really bad lending standards. So right now it is way more regulated. For example, I have to tell this to all my clients every time. Back in 2006, we had people getting these ninja loans. You didn't need an income, you didn't need any asset or anything. They would just literally qualify you based on nothing, pretty much. As long as you could breathe, you could fog a mirror, you could buy a home, which is a big deal for for the real estate market, because if you have all these buyers propping up the market like this, obviously we are destined to have a big crash coming up. And at the same time, however, these buyers, they weren't locking in 30-year fixed interest rates. They were locking in variable interest rates. And as these the way the variable interest rate loan works is that you lock in an interest rate for, let's say, a year or 2 years or 3 years or 5 years. And then what it does, it escalates as interest rates go up over time. And that really caused interest rates to skyrocket and people were underwater. So what happens is, let's say in today's environment right now, if interest rates go up, or actually, sorry, let me backtrack right there. Back in 2008 or 2006, what we had is home prices going up, but at the same time, interest rates were going up, and then all these people that locked in these variable interest rate loans were being subject to all these rates increases. So now their home mortgage would go from 1,100, for example, to 1,300, to 1,700, to $2,000 a month, and they had no control over that. So that was one of the main issues back in 2006. And however, we do not have that situation right now. So very, very important that we say that right now, because right now the lending standards, they're literally going to check everything, your background and everything. They're going to make sure, they're going to call your employer to make sure that you actually have a stable job. And they're going to lock in also a 30-year fixed interest rate loan. So we cannot compare apples and oranges, is what I'm saying, between 2006 and today. Okay, that's very important. And right here, we also see that waiting for the market crash might not yield the results that buyers hope for. In fact, experts say that not really, there's not really any room for there to be a bubble right now. And it's funny because it's tough to say that, because the moment I say that, a lot of people just click out and say, no, this is a bubble, you have no idea what you're talking about. And that's okay, but I need to understand, all these people that tell me that there's no bubble, that there's a bubble, well, I asked them, why is there a bubble? What's causing a bubble? And nobody can give me an answer. So if you do have an answer to that, let me know down in the comments. I'd love to hear your opinion. I'm always open to understand the situation. But so far, there hasn't been one answer that I haven't been able to reply to that could justify why there's a bubble in today's market. So let me know down in the comments. But so far, seeing this data, the lending standards and everything, we see that 2006 and today is completely different. Regardless, I've been saying this ever since COVID happened. I have some videos in my main channel that I talked about how the real estate market is it's probably going to go crazy in the next 2 years. And so it has happened. And this is when everybody was saying, oh, the virus, the economy is shut down, real estate prices are going to tank, they're going to go down to zero, or they're going to half or whatever, right? And I purchased homes back then, and I'm glad I did. But that's the point. I literally interpreted some data, and that's what I'm trying to portray to you, to give you this data so you can make a better educated decision based on your situation. Again, I'm not an advisor. If you're one of my clients, I'm not advising you to do one way or another one. I'm just telling you what I see personally, and then you can interpret this data your way. Anyway, let's move forward. Things have changed since 2006. We talked about that, how the mortgage underwriting was considerably more loose back in 2006. The whole deal with these what's it called? These bonds that they used to just give out to people, and then the balloon payments. I mean, why would you pay so much for? Why would you pay for a mortgage that is going up with interest rate and it's giving you a higher, higher payment every month when the house is crashing in value? Of course, everybody was going to default, and that's why we had this huge recession. One big deal is that we have today. We have the 30-year fixed rate mortgages, which is, and it really takes away all the risk from the people that locked in these super low interest rates. But here's what they're mentioning. There aren't enough homes to sell. So at the end of the day, it all comes down to supply and demand. How many homes are up for sale and how many buyers are out there purchasing homes? These two factors are going to determine what is going to happen with prices in the real estate market. And what you have to understand is that, okay, yes, all these people that purchase these 30-year fixed interest rate loans, they're probably very unlikely to sell their house unless they really have to, in order to go and buy another home, or just sell their house because they don't want it anymore. Because what happens is, if you have this 3% interest rate, and you know that for 30 years you don't have to pay anything more than what the payment is, maybe taxes go up a little bit or all that stuff, what's going to motivate that seller, that person that owns that loan and that house? What's going to motivate them to actually sell the house? And the answer is, I don't see any reason why they would sell. I would keep it, if anything, and just rent it out. So that's a big issue because there aren't any homes. Also, as far as the amount of homes that have been built in the last decade, we're like at a fourth or even a fifth of what they used to build. Let's say in the decade prior to 2010. So this is a big issue when you don't have enough homes, that are not building homes. Builders have supply shortages where they can't build fast enough for the demand that we have, and we have this huge amount of money printing, which is causing inflation. We all see the inflation. According to the CPI, it's 8%. It's probably way more than that, but the way they calculate CPI is completely wrong, in my opinion. But that is all for another video, which I'll be posting pretty soon. But what this means is that if you have a lot of inflation, you have a 3% interest rate loan on your house, you're not going to sell that. People are not going to move from their home, because if they were to move right now, they have to sell that 3% interest rate loan and buy it a 5% interest rate loan, for example. So that's a big difference in payment. In fact, if we go to Redfin right here, let's say we get this house that is $470,000, right? A 2,000 square feet home. And we go down there and we look at the payment calculator. Now, this is the interest rate that they're estimating right here. What I'm going to do is I'm going to give you an interest rate. Let's say you put down 20% on the house, okay? And then we do a 30-year loan at 2.75, which is, actually, let's do 3%. That's what we were getting interest rates at a few months back, right? Now, the mortgage payment is $1,854. So this is what people were locking in now. Let's say I were to sell this house right now and buy it again at 5% interest rate, or maybe move up, upsize or whatever, downsize on a house, whatever you want to do, from $1,850 a month, this mortgage would go to $2,282. That's over $400 in difference. That's a lot of money. That's about 25% extra just because of the extra 2% in interest rate. Usually that's the rule. When you have a 1% increase in interest rates, you get a higher price of about 10% a month on your mortgage payments. So if someone has to go and live in another house for a higher payment, there has to be it doesn't really make sense for people to move. That means less homes come on the market for sale, which means it props up the market even more. So at some point, people say that because interest rates are rising, now people can afford less, so they won't purchase anymore. That's just not true. Actually, the prices could go even more higher. What my opinion is, and this is my strict opinion, is that the quality of life of people is going to go down, which means what they can afford is going to be less, but people are still going to buy because people always have to live somewhere. So my prediction, this personal, just speculation, I have no control over this, right? But what I think is going to happen is people, instead of buying, let's say, a 2,500 square feet home, they're going to start buying a 2,000 square feet home, or an 1,800 square feet home, or a 500, or whatever, a two-bedroom condo, instead of buying a home. So the standard of living is going to go down, but the prices are going to stay up, if not even increase. And we can see this in the major cities, This is hedonic, inflation is what they call it, or something like that. But don't quote me on that, because I'm not big on these big words. But what happens is, instead of having inflation in price, you get people that start, living in smaller places, and buying a condo, for example, in San Francisco or LA or New York, New Jersey right now, it would cost you like $700,000. Now that is pretty much replacing a huge home that you could buy maybe back in the day with something smaller and smaller. So people are, they adapt to different standards of living, and that's what's going to happen next, in my opinion. So if you can qualify for a certain amount of home right now, eventually we're going to get to a point where you're only going to be able to qualify, for example, for a condo. That's the kind of inflation that we will be seeing. And that's happening mainly for one reason, and that is inflation, which is money printing from the government. They issue these bonds and they just Actually, they start buying down bonds, and which creates a lot of debt in the system, which props up asset prices. That's just the way it is, and I don't want to get it too much into detail with that because that's material for another video. Anyway, there aren't enough homes because people are not selling due to the fact that they locked in a low interest rate, 3% for 30 years. And also because builders are not building enough. We have a shortage of homes that has been happening for a long time. So we're destined, in my opinion, for prices to go up. Now, as you can see here, builders are struggling to catch up. We have labor issues. I mean, you go to any new construction builder out there, you see what they have going on in the homes. You'll barely see any people in the houses working on those homes because they're all backed up. You go to American West, it's taking them over a year to build a home, like a regular 2,000 square feet home. That's because they don't have the electricians, they don't have the plumbers, they don't have any workers that are willing to go out there and work on these things, which is a big issue for builders. And the lending, home builders, especially the smaller companies, face a tighter market for borrowing the money needed to build. They just cannot get enough money to build all these houses in advance. And it also has to make sense. You got to think about this, because you might be asking yourself right now, well, why don't builders just build more homes and they make more money? It's not that easy if you don't have the people to work, and also you have to make a profit on the house. If there is no profit to be made, then they're not going to build. And that's the issue that we have right now, because all the materials, the lumber, the copper, all the materials that you need to build a home, including labor, has become way more expensive. So building a house is not profitable for them anymore. And in my opinion, unless we see these prices going down for lumber and all these stuff and all these materials to build a home, and also labor, which is very unlikely, the prices are going to keep going up to build homes. And here's the thing, if prices don't keep going up because it's not profitable to build a home from scratch, what happens is builders are not going to build. If there's no profit to be made, they're not going to build. It's just the way it is. So if that is the case, it's going to restrict, again, the supply, which means prices are going to keep going up because, again, it's all about supply and demand. So I want you to understand this principle right here. And I'm not saying that there's not going to be a correction. There might be a correction, but we're going to get into that later. Also, laws and regulations. Try to build a home, let's say in California. You hear it all the time where, there are some, major rules and regulations they're very strict that you have to go through in order to build a house. And it's very expensive to get all the licensing and all that stuff, which adds extra costs to building a house. So that's the issue with the supply. Also, fewer people are selling there's an article right here, a survey by Discover Home Loans, and it says that found 79% of homeowners would rather renovate their homes than move. And again, that goes back to their low interest rate, their low payment that they have locked in for 30 years. They say, look, I'm just going to put $10,000, $20,000 in the house and stay here because I can keep my $1,800 payment versus going to the $300 payment. I'd rather keep that low payment and renovate it and stay in this house, which again slows down the supply or keeps the supply low. And if we look at a little bit what happened, and we'll get into the buyer side, so the demand side in a second, but if we look at what happens with the homes for sale, right, and how many homes do we have for sale right now, right? And we look at this is ever since 2006. So as you can see, as there are more homes for sale, prices go up. Okay, prices go down. So we see here back in 2006, that's when supply started getting up there because the bubble started bursting, right? And it takes time. Real estate takes time for it to act, right? And then as we saw more and more supply, we went up all the way to 27,000 homes on the market. And this is for the Las Vegas real estate market, okay? This is the Las Vegas Valley, North Las Vegas, Henderson, and all that stuff, right? We have 27,000 homes on the market back in July 2011. That was the bottom of the real estate market. You would buy a home back here. It was the perfect time to buy. I mean, we're talking about pennies on the dollars. But then ever since then, supply has been going down. And we saw this huge supply restraint, so we went from pretty much 27,000 homes on the market down to $13,000 homes on the market. And this is more of a like a regular market. This is probably about 5 months, 6 months of supply. And that is a normal market. And then it kept this normal market with, prices kept increasing a little bit until, December 2016, 2017 hit. And I remember the summer of 2017 all the way until May 2018, the summer, it was crazy because prices kept going up and up because of the supply going down. Okay. Now, what happened in 2018? They raised interest rates. But the economy wasn't in a great situation back then, right? So they raised interest rates, and prices adjusted 10% with supply going up, which is understandable. Okay, but immediately, literally, we saw the difference on the market. I saw it on the market, like literally, 1 month after, the homes were selling for 10% less than what they were selling the month before. And you saw this increase in spike in homes up for sale, up to 13,000 homes. Then the Federal Reserve adjusted the interest rates. It went down and all that stuff. And then we saw this slow, taper down. And we have homes on the market right now. We are down at 5,782 homes on the market up for sale. And if you look at the months of supply, that's pretty much the same. You see, it's been, what is this showing here? Yeah, it's pretty much the same thing right here. 5 months, 4 months, 3 months. Then we're down to 1 month of supply of homes. Okay. Now, how about prices? Where are prices going? Well, first let's talk about the buyer side. Okay. So, let's see. There are more buyers on the market. So this article is saying, look, supply constraints mean that there aren't as many homes for people to compete for. So, those open houses are also busier than ever, blah, 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 and all this stuff. There's a lot of homes, right? Demand for homes right now. And what are they saying? Blah, blah, blah. We know that that's the case with the pandemic. What happened is a lot of people went to work from home. In fact, we have seen cities that, states like Nevada, Las Vegas, where we live in, where we have 0% state income taxes. We have seen this big influx of people working from home. They're saying, look, I can move to Nevada and save, from California and save 13% on my taxes that I don't have to pay the state by just moving to Nevada, and my pay is going to stay the same. So we have this big influx. In fact, Las Vegas has seen a big appreciation because of that reason. A big influx of these people. So more people are buying homes, however, because what they're understanding is, hey, the value of the home is huge due to the fact that if you need to even work from home, you need a nice place that you can buy, you can lock up, and renting a house is not safe in an inflationary environment, because what happens is rent prices go up. In fact, we look at the demand right here. I mean, the average rent price ever since 1940, it used to be $27 a month to rent a house. Now we have, you see how rent prices have gone up. It's pretty much a straight line. I mean, just a few dips here. This is on the dot-com bust, whatever it was, and then the Great Recession with the housing prices going down like crazy. But you see, even during recessions, rents stay the same, if not even increase during recession, because people still need to live somewhere. If there's a recession, most likely they lose their jobs, they cannot buy a home, and if they can't buy a home, what do they need to do? They need to rent a house. So people keep renting, and rent prices just keep going up, which is very healthy for the real estate market today. Another reason why I think the real estate market is healthy, because as long as it's more expensive to rent a house, why would people not buy? Because if you buy, you lock in a rate for 30 years, versus if you rent, you're subject to rent increases. So if it's cheaper to buy right now, which still is with the 5% interest rates, right now you probably break even or save a few $100s a month if you were to buy. Then you're locking in that rate for 30 years, which is huge, plus appreciation, all the stuff that you're getting. So that's why it's pushing people, even though interest rates are increasing, to actually keep increasing, for prices to still keep increasing. Anyway, we look at what's happened lately, though, in the market, right? I go, let's say, to the last year, and this is the inventory. Let's say the homes for sale, right? We're looking at just a straight line down. Now, I don't know what's going to happen now. This is like the houses for sale in March. This is after pretty much in March we had probably like 4.5% interest rates, up from 2.75 back in December. Okay, so that's a big increase. That's almost 2%. Yet we see homes. There's less supply on the market ever since. Let's see, December we had $6,000 homes, 6,200 homes on the market. And now in March, we have 5,700 homes on the market. That's a big decrease. That's about 10% decrease of homes on the market, which means 10% increase which in purchase price, which is pretty much the case. We've seen a huge increase since December to now. So something to keep in consideration, even though interest rates are rising, that is not creating any supply in the market because people cannot sell. And the only way out, in my opinion, is people will not live the life that they live so far. They're going to have to go down in the quality of life. They have to buy condos instead of buying homes, but prices will stay up and continue to rise. Maybe not as fast of a price as before, but the quality of life for people will go down, in my opinion, which is the same case right now. It happens the same thing when you are going to do groceries. If the price of beef, for example, has increased, and this is just a comparison, right? If you see you have an option to buy a piece of beef, right, a steak, or you buy chicken breast. Okay, you have these two options. The steak is going to cost you right now, let's say $20 for the steak, even though a few years back it was $10, right? But since prices have gone up, the chicken was $5 and went up to $10, and then the steak was $10 and went up to $20. Now, if you only have $10 to spend on steak, what people are going to do is, instead of buying the steak that they would buy before, they're going to buy the chicken, which means they're not going to be able to enjoy the steak. They'll only be able to enjoy the chicken, which is a big, but it's not like they're going to starve. They're still going to be able to survive off of chicken. It's just that what happens is people are not going to enjoy the quality of life that they used to enjoy anymore, which would be the steak, right? And it's the same thing with homes. People, that used to afford to buy a home will be able to only afford to buy a condo now. They're still going to provide them a house and a shelter, and their needs are going to be met, but they're not going to get all their wants. That's my prediction so far on the real estate market. Now, when will the housing market calm down? This article is saying, and according to experts. Well, I don't consider Zillow an expert, but they say Zillow predicted that in 2 years before monthly inventory returns to pre-pandemic norms. Maybe, I don't know that, honestly. All I know is that there's shortages of supply and a bunch of people that want to buy homes because we have, people will always need to buy a home somewhere. Whereas again reaches 45% seen in 2019. So that's going to be tough, I think. It probably will happen if interest rates keep rising because it will slow down the market. We might not see that appreciation that we've been seeing, like 26% in 2 years. We'll probably get that 3-5% appreciation every year, so it will slow down possibly. The thing is, here's the thing. If you have to buy a home right now, right, and you have to spend, and you have to pay, let's say, a 5% interest rate, or even if it goes up to 7%, right? If you know that inflation is 8-9%, why wait to buy a home? If you can afford a house right now today at 7%, okay, and you have inflation of 8%, literally it's what they're saying, that the CPI is at 8%, although I think it's way more than that. They're saying the CPI is 8%. You're still making 1% a year in equity on your house. And you're not renting, you're locking in for 30 years. And let's say interest rates do end up coming down, which will prop up the market again. What's going to happen is you are going to be able to refinance at a lower rate, decreasing your mortgage payment a lot, but locking in a home price way before, the next interest rates, start going down again. But that's my thought on this. That's why I think it might slow down the market, because what's going to happen is all those buyers that were, probably investors saying, you know what, interest rates are so low, I'm just going to go ahead and, and buy. And, I know I'm not going to make because I was going to make so much money every month and, collect all this extra cash flow on the property. I'm going to keep buying, with these low interest rates. Now, all those buyers that don't need to buy, but they were buying just because interest rates are so low, those are going to be gone, which is going to help a little bit and allow people that actually need to buy to get into a house, and hopefully slow down a little bit the market and get a little bit of, allow people to breathe and actually buy a home without these crazy 10% increases over 3 months, which is unsustainable. So yeah, I think, honestly, in my opinion, I think this is actually a really good news for mortgage rates increasing. Although it hurts you as the buyer to pay more every month, I understand. But it is healthy for the real estate market, because it will allow to push out all the investors, all those people that it will allow to get a little bit of supply. With that said, that's what I think is going to happen in the coming next. But here it says, what can home buyers do in this market? And you have to be strategic and what you want, to be patient, blah, blah, blah. Patient is different from waiting for a crash. And that's the thing, people say, oh, I'm going to wait for the next crash to happen. Or, whenever that they think that it's going to be happening. Like, I just had a call today from, somebody from California called me. They said, oh, yes, I want to buy. I'm going to come out to see some homes, but I'm not going to buy until, for 2 or 3 years, because I think that's when the crash is going to happen. And then I'm going to buy in 2 to 3 years. And they might be right. But the problem is you can't time the market. And my opinion is that you should buy when you're ready, when you need to buy, and just buy for the long term. Don't look at the short-term gains or, whatever it is that is going to happen in the short term. If you're that kind of buyer, then probably you shouldn't buy. But if you're looking to buy a home that you're going to live in, it's a no-brainer in my opinion, because interest rates, relatively speaking, relative to the historical interest rates, we're actually a pretty low interest rate right now, because back in the 80s, for example, we had up to 18% interest rates on home mortgage loans. So that's pretty high. But also, last thing I wanted to mention is, if you look at the last recessions that we had back in the 70s and 80s, or before that, what we see is, even though, regardless of what interest rates have done, even in the 80s when we had that huge inflation spike, that they had to bring up the interest rates up to 18%. That did not crash the market, actually. It made it actually, it kept going up. And, ever since then, we had interest rates go down. But it doesn't mean because interest rates are going up that the market is going to crash. We saw it back in history. And out of all the recessions that we had before, the only recession that caused home prices to decline, it was the one in 2006, 2008, the Great Recession. And that, again, going back to the reasons why it crashed, it was because of the mortgage lending standards. The variable interest rates, the bad lending standards, anybody could get a loan. That was the poison of that recession. That does not mean that that's what's going to happen right now. And I just wanted you to be aware of that situation. That way you can make a more, a better educated decision. I don't think I have anything else for you guys. If you guys like these kinds of videos, let me know down in the comments. Let me know your opinion when you think the market is going to crash. If you haven't done so already, this is my new channel. Subscribe to the channel. That way you get notified every time I post a new video on here. I'm going to be talking more about market updates and things like that. So if you haven't done so already, subscribe, hit the like button, and I'll see you guys in the next video.